96%. That's the number of stocks that were up over the last 24 hours in the S&P 500. And with two large sessions over the last 10 days, could it be that Wall Street is finally buying the dip? Well, as it turns out, in today's video, we'll share with you the dark pool liquidity that made it all happen. And it looks like there's some big moves going on around the world. With digital gold becoming the new big thing of the last 48 hours, as we suspected, gold itself took a bit of a dive. And in today's video, we'll share with you the data surrounding that, along with the big earnings season that is kicking off. Even though Tesla had a bad result, the stock still rallied. Why was that? Let's take a look today as we cover stocks, commodities, and cryptos together. This one's not to be missed, guys. We'll see you in a moment. Well, welcome back, everybody, to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the data, and of course, the key levels coming your way. But let's kick things off with the 96% breadth day that we just witnessed on the markets, the second of the last 10 days. As you can see here from Subu Trade, this is a pretty good statistic when we're talking about forming structural base. And although it doesn't mean that we won't see a lower low in the future, in fact, that happens quite often in these particular reads, such as 2015-16 and 2011-12, this can be a great sign of forming what is a very key level for investors and position-based buyers. In fact, 2 months later after seeing reads such as this, we are 100% up in terms of the markets, and the percentages are not too shabby either, an average of 7% over that period of time. And this is what we've long suspected. We're going to trade in this trading range with huge up and down days, and in particular, movements that are going to shock many retail investors like you and I. Now, let's take a look at what actually happened in terms of the investment overall. As you guys can see here, there were a couple of large trades that came through, specifically in some very, very key markets. IVV, one of the biggest S&P 500 ETFs, just got its fifth largest trade ever during the session. On top of that, we saw the SPY, one of the biggest market index positions, defending the sixth largest trade zone. And of course, we saw some big sweeps and dark pools coming through large cap funds such as SCHG and a few others. And this is a big deal because this is exactly what we were looking for over the last 24 hours to tell us that there were people buying the dip. On top of this, we've come back to a key zone such as the daily 20 moving average, which we'll look at later on. And we potentially are making a higher high, which is the first change of trend that we've had over the last kind of half a week to week. This is great for day traders, big for swing traders, and of course, a positive sign. Now, if we look at all of the sell-offs in history, really the one that makes the most amount of sense right now is the 1998 analog. Well, this continues to hold very strongly. In fact, what traditionally has happened is the market sold off, formed a base, rallied, dropped, rallied again, and then, of course, went back down to make what we call a double bottom. Now, as you saw before, that actually becomes very likely as well when you have these 96% breadth sessions. And what this is good for is it's good to kind of say, okay, well, this is a key holding zone for markets. When markets get down into this bottom quartile, then maybe you want to be a buyer. When markets are up near that supply or resistance zone, maybe you want to be a seller. And it's that perfect period for the day trader, for the scalper to be involved in markets. For investors, it's like very frustrating because, of course, you see your portfolio go up and down 5% on a whim on a session. And unless you've been in something like gold or maybe even Bitcoin in more recent times, such as last week, you probably have seen your portfolio switch quite a lot. If you are a believer, though, that things will improve, then this is probably the best analog for you. And that is the 1998 to the 2025 overlay. And at this stage, it is the most correlated that we have. Now, on the bad side of things comes this chart. We've shared this several times, which is, of course, the Cisco or the dot-com bubble with NVIDIA. Now, if you look at it, NVIDIA, semiconductors, technology stocks, all of those really need to improve to get another bull run going. And at the moment, we find ourselves in this chop, basically a zone where the markets are going up and down quite a lot. And if we do break down too much more, we'll effectively enter into what's called the recessionary path or a structural break. And this is of course, very negative sign for markets. So what happens here is incredibly important. and will probably define the next 12 to 18 months. On top of that, CTA positioning for the bulls is still good. Now, we first reported on this around 2 weeks ago, and since that point, we've actually seen a little bit of CTA purchasing, which is good because basically this means momentum is starting to shift from the oversold into the buying across the board. And this is the type of thing that we want to see at these lows. On top of this as well, smart money seems to be buying these dips for now. Now, this doesn't mean that you go in there and you say, wow, smart money's buying, let's all go crazy. But when you tend to see these particular drops, some notable periods, 2009, of course, 2011, 2018, near the end there, of course, the tariff period that we talked about, and 2022. When you get these huge upticks in smart money, that is a good sign that somebody is at least seeing some value in markets. On the flip side of this, we will ultimately need bulls to come back and really support this market though. So although we're in a dip, we do need sentiment to shift towards the upside. And this is what you would call max fear, or at least close to max fear. No matter what sentiment indicator you're looking at right now, as we've shown several times before, most of them are so fearful that it leads into things such as 2009, the bottoms, or even a 2001, 2002 style period. Now, what about this one, CAPX? Well, this is bad because, of course, when we tend to see CAPEX hit these levels, this is not a good sign for the future growth of the US. And the latest data here, according to Renaissance Macro Research, yeah, it's not so good. So CAPEX seems to be failing. And this is not the type of thing that you want to look for when you're going for 4, 5, or multiple year growth. When it drops like this, it really means that we need stimulus. And basically that means the Federal Reserve or some form of government support. Tax cuts, anybody? That is, of course, something we may be looking for in the future. Now, this has recently dropped off a cliff. And that basically means that no one is looking at spending money in the US moving forward, or at least this seems to be dropping heavily. And that is, of course, a big concern because if we don't see this pick back up, it could have dramatic ramifications for the next 12, 18, or even multiple years. Now, some other times where we've seen huge drops like this were, of course, one of the periods here back in 2011. We saw it during the first tariff kind of area during 18, 19, and that ultimately was supported by, remember, the Fed up until the COVID saga. And we've seen it dropping already over the last couple of years. But this steady decline or this steep decline that we've just seen needs to be watched, and we will be tracking this throughout the rest of this year. So make sure to subscribe if you're interested in that data. Certainly a worrying sign for the people out there that are looking at macro and thinking about their portfolios in the years to come. Let's now have a look at Tesla's report. So basically it was bad. I mean, it was really bad. And it doesn't really matter.
Netflix Inc. reported strong first quarter earnings with 13% revenue growth, raising investor confidence. The company aims to double revenue and reach a $1 trillion market cap by 2030, targeting 410 million subscribers. Analysts have raised price targets reflecting optimism about Netflix's growth strategy and market position. Woods RQ ETF sold 26,405 shares of Microsoft, valued at $9.7 million, amid concerns over halted data center expansions. Despite this, analysts remain bullish on Microsoft's long-term potential, with a strong buy consensus rating and a price target suggesting 35.5% upside. MSFT stock is down 12.8% year-to-date. Analysts maintain buy ratings for Eli Lilly and Company, citing strong long-term growth prospects despite short-term challenges. Price targets set at $989 and $1,100 reflect confidence in recovery and growth potential. If NVIDIA also gets a new license to export to China, or if that restriction gets removed during negotiations, I think we might see another 10% jump. And if first quarter results are above what is expected, we might see 130 to 140 within May. Or am I too optimistic? What do you think? Please comment.